If you're not caught up on the mounting national debt crises around the world, you can get up to speed with our video on it over here. But, as BlackRock points out, spiralling national debt is increasing the appeal of, quote, alternative reserve assets as a potential hedge against possible future events affecting the US dollar. The authors cite their own experience with clients and claim that this driver, quote, explains a substantial portion of the recent broadening institutional interest in Bitcoin. So, perhaps you can see how TradFi investors' perception of BTC has evolved from wildcard to flight to safety in times of macroeconomic stress. Or at least this is the case for investors who have a solid understanding of Bitcoin. I say this because the market tends to show a mixed reaction when faced with macroeconomic shocks. As the report explains, BTC usually dumps pretty hard before quickly recovering and proceeding to rally. This price action suggests a market divided between those who consider it a risk-on asset and those who view it as a flight to safety. The authors attribute this dump and pump reaction to two factors, one being the immature nature of the crypto market and investors' understanding of Bitcoin. This makes sense, but we find the other factor more persuasive. And that's the fact that Bitcoin trades 24/7 and settles to cash almost instantly. Because it is so saleable, it functions as a kind of alarm bell during periods of stressed liquidity in traditional markets, especially over weekends. Although, for what it's worth, there's also a third factor that we can't leave out, and that is just leverage traders getting liquidated. Leverage degens are a huge part of why BTC tends to dip so hard whenever financial markets get spooked. One liquidation tends to trigger another, and this domino effect drags the price of BTC down more sharply than most people expect.